All right. So right now, let's look at our calendar. We have something known as triple witching happening today. That happens 4 times a year, once a quarter, and it's basically an expiration of options. And there's a lot of volatility during triple witching. We have another thing is on Fridays there's a lot of traders that take off and they don't trade, so you have a lot of low volume, and that could lead to a high amount of volatility. So we're coming up into the December timeline. There's no significant correlation between the week before Christmas, and the stock market going up. But after Christmas, there's usually a Santa rally. We have a pretty negative underpinning of the market in the next couple months, because we have to wait until February for the next Fed meeting. So that means basically from now until maybe March or April, it's just going to be either flat to down. So maybe this year we're going to come up with a strategy. I'll figure something out, but strategy to make money. I'm thinking, looking at some of the stochastics in the stocks we're following and in the indexes, a lot of the downtrends are starting to turn into sideways patterns for a lot of the stocks we're watching. So there was a period of time between 2000 and 2008 or 2010 where the stock market basically didn't do anything. It was basically, it didn't go up. It just went sideways. So it looks like we're going to be at a period of time in the stock market, at least for the next 6 months, we're going sideways to down. So we'll have to come up with some kind of strategy to make money, and in that kind of environment. Right, so we do have the end of the year Santa rally. It might not happen this year, but usually there is one, and we have quarter and window dressing. And we have 2 holidays, and people get really happy and excited around Christmas and New Year's. So we're looking forward to that. But in general, we just have a lot of negative reports coming out now about the economy, and how things are slowing down. So let me see. All right. So basically, we're at. Let's look at our talking points. The 10-year is down 1% this week, and the 2-year is down 1% this week. So basically, we're at parity with the Fed funds rate. That's a pretty good indication that we're close. We're very close to stopping raising rates. And so it seems like what's going to happen is maybe we have a little bit more raising of rates, but for the next 6 months or so, we're going to get flat to lower earnings growth for a majority of the stocks we're following. So that means that stocks that are trading at a very high PE ratio are not going to be doing good just like this year. And we're going to start following basically the trends, sideways trends throughout the year, I think. So next year we're just going to be going up and down and in a sideways pattern instead of up for majority of things we're watching. Okay, so let's look at, you see. Okay, so we know the Fed raised the rates 50 basis points, and that is an indication that that we're going to have. We're already seeing problems in the economy. We saw that the manufacturing sector was growing for 30 months. Now, all of a sudden, it's starting to go down. The housing, of course, is part of that. And housing is slowing. We all know that houses aren't selling as much. So you don't buy as many appliances, and the people don't fix up things as much. So retail sales just yesterday said that it's going down. So GDP growth is basically going down, and so we have all kind of indications that we're going to be in a sideways to flat environment for the next year. So we have to wait for another month for earnings to come in. So we can't have any of that to pull us out of this. And we're currently oversold. So if we look at the S&P chart, let's look at the S&P chart. Last week we were at the top of this range, our downward trending, lower lows, lower highs, lower lows, lower highs. So I said, well, at that time, there's a good chance that we would go back down to here, seeing that until the Fed is done raising rates or we get some indication that they're done, we're just going to follow this pattern of lower highs, lower lows. So there's a very good chance we'll get down to here. In this quagmire of until the Fed raises raises the rates one more last time, we're going to go sideways to down, most likely in the stock market. So, but we're still in this channel, so that's not good. But we're starting to develop an uptrend. As you can see, this 2 lines I drew here. So, if we break down out of this and we start going lower, we know there's a 90% chance we're going to go down to here and then up to here next. So, this isn't 100%. It's just we're just following patterns, and this seems to be the current pattern. It's been active for a whole year, so it's pretty reliable. The DXY is still going down. It's in a downtrend. That's really good for our multinational companies. So the lower the dollar goes down, the better it is for the earnings of Google, Apple, all the companies selling overseas. See, fear greed index. We're neutral now. So we're actually going to a point where people are fearful, and there's a chance that we're going to have a sell-off in January, because people have been greedy for a while now. Extreme greed. No, we haven't been extreme greed, but people are starting to get more fearful, and we're getting indications that that people are getting. You see that the VIX is up, so people are starting to get a little more cautious, and so that's whenever the VIX. Right now we're at complacency, but we're leaning towards going up the fear. So we like to look at this for contrary viewpoints. So when it gets to extreme fear, that's the time we like to start looking to buy things or start looking at, buy things. And whenever things are extreme greed, we're looking to sell things. Like we were saying, where was it? Right here. We were saying, well, if you don't like the idea of volatility and you're a little nervous, it's time to get out then. So that's the time when people are greedy. We had greed last week and the week before. That's the time to sell if you're trying to get out of a position. And then when people have extreme fear, that's the time to start buying. But we are in an oversold condition right now in the market. So we know from the stochastics we're at around 32 right now. That's pretty close to oversold. So it seems like our stochastics are following this new pattern here. The higher highs, higher lows. So we could, in a good New Year rally until January 1st, we could get up to here and basically hit this top of this line. And who knows what will happen after that. Most likely we'll go back down to here. Okay, so first of all, I'd like to know if anyone has any questions at all. Any questions? Great. No questions. If you have questions during the talk, let me know and I'll go over it. Okay, so we don't have any real good catalysts one way or another happening this week. We got a little bit closer to an understanding of when the Fed is going to stop raising the rates, and they're almost at parity now. So that means the Fed funds rate is right around the 2-year. So that means there's a very good chance we're either stopping now or stopping 25 basis points above where we're at. Okay, so next time we'll come up with a plan. Like we did Christmas of last year, we came up with a plan of how to trade this market. Let's go back and look. Let's go back and look at our meeting notes from last year and see how that panned out for this year. So we were looking at let's look at what we were saying then. Okay, so last December at this time, we had a plan to move out of high valuation stocks into ones with lower valuations. So example, out of tech with high PE ratios in the banks, drug stocks, phone companies with low PEs. And we were still preparing for the end of year Santa rally. That happened last year. Stocks that did bad last year have gone down more, and then the ones that do bad last year are usually the ones that do better this year. And so we were saying that biotech drug stocks were very poor performers in that year, and they will probably be outperforming in the next year, and that's what happened. Okay, let's see. Okay, so what we're going to do is next meeting is our last meeting of this year, most likely. We'll come up with a very similar outlook for next year. I'm thinking what we'll be doing is we'll be assuming that a certain portion of our portfolio will be just, I think it's called trading around a position. So if we have stocks that are, basically not going anywhere for 10 years, which very well may happen, we want to be able to make money in all circumstances. So we can pick out the stocks like, we can pick out stocks like T-Mobile that are still growing at 30%, and buy them lows like today and sell them or not buy them when they're high. And we could we could trade stocks in a range like this every month or so, just in case we have a situation where we have 10 years of non-growth like it was in 2000. Okay, so let's see. What other notes we have here? Okay, crude oil. It's giving an indication that there's a global slowdown. Whenever the price of oil goes down, that's an indication usually that there's a slowdown in the global economy, and that usually means stocks are not going to do well. When the price of oil goes high, that means there's a high demand for oil, a lot of activity in the economy in the world. That means there's more demand. So I added that just to keep that in mind as this price of oil goes up and down. But the biggest thing about this oil price is the Strategic Petroleum Reserve of America. We're actually starting to reload our stockpiles at $70 a share, $70 a barrel. So that's like a put. So if we know that there's a big buyer, America, going to be buying a lot of oil at $70 a barrel, that means it'll probably not go lower than 70. Or there's at least a certain period of time where America's buying oil and it's not going to be going down. So that's something to think about with oil. Let me see. Right, so let's look at what else we going to look at. Okay, so we know all this. Okay, this is an example of today's a triple witching day, which I already mentioned. It's an explosion of volatility. So stocks could go up and down. Basically, what's happening right now is there are options contracts that are being settled. So if you bought a call that allowed you to buy a certain stock at a certain price, and you exercise that, then you got to buy like an artificial amount of that. You buy that, and then makes the volatility go crazy. And there's a lot of that expiring today. So during the day, there's going to be this exercising of options, which only happens 4 times a year. So the next time it's going to happen, do I have that? In 3 more months. Okay, so let me see. There's an article I read, Apple versus Microsoft. One outperforming fund manager has picked his favorite and explains why. This is very interesting because, we've kind of treated them the same in general. They're both kind of higher PE stocks, like a PE of 20s, in the 20s. And this manager favors Microsoft. And the reason, he says free cash flow will remain important, and Apple shares, they perform better because they've been buying back a lot more of their shares. But there's something called shareholders' equity. Shareholders' equity is Apple's shareholders' equity is going down, where Microsoft's is going up. So Apple's buying more of their stock back with the equity they have on hand, and Microsoft's investing that. They're doing more investing. So the total equity has risen by 47%, and they're investing in buying companies out, and they did a deal with our London Stock Exchange, and so that means they're committed to growing their cloud business. So they're investing a lot more, and they're retaining more of their cash. So they have a more diversified revenue stream. So so this guy likes Microsoft better, even though it has a higher PE ratio. It's a little more stable and diversified income. I thought that was pretty interesting. I got let's look at Yahoo Finance. Okay, you can see on the major indexes that we're going down. Okay, so Tesla is in free fall. We've been saying for over 2 years now that Tesla has been overvalued. Last week we said it was overvalued by 1.5%. The one problem right now with Tesla is they don't have the focus of Elon Musk anymore, and he always pushed the company. And now you have an added problem with Tesla where Elon Musk is selling shares to prop up the Twitter company he just bought. And that forced selling is really affecting the stock price. And it'll probably trade down to a PEG ratio of 1. Right now it's 1.5. So yeah, it's still pretty pricey. Let me see what else is happening here. I think what's happening with crypto is it's starting to unravel, and there's all kind of people are going to be brought into this mess. So it's probably best to keep out of that if you're interested in it. It's not an investment. I think we've been saying for 2 years now that it's a scam. So eventually it'll all be evident to everyone that there's someone manipulating the whole system and people are getting ripped off. Let me see, what else is happening? Okay, we got a couple of these on our talking points today. So let's go to the market movers. Okay, so we see Adobe is up today. They had a good earnings report. We're going to go over Adobe later on. Meta is actually upgraded by JP Morgan. We'll go over that. Basically, Meta has JP Morgan said that they're pretty much oversold, and one of the catalysts for Meta is they might ban TikTok in America. They're one major problem And so if they ban TikTok, then they might resume growth in the social networking part of their company. One thing about Generac is a backup generator company. So you have a machine in the back of your house that powers your house if there's a power outage, and they do rooftop solar installations. But one big problem for Generac is there's a Ford F1 Lightning that serves the same purpose as that, and you could power your house with a car instead of one of those. So that's like a major competitor to them that they didn't have before. They had almost a monopoly, not a monopoly in California anyway. So, let's see, what else is happening here? The theme for this today is Nope, no theme. The ones that are going down the most, Moderna, it had a big run up earlier this week on cancer vaccine news. Ford is down. Car company, no. What else is happening? Okay, I don't see any commonality in stocks that are going down. Car companies, CarMax, Ford. Capital One. No, I don't see any commonalities. Let's look at the NASDAQ. Okay, I think as long as Elon Musk is running Tesla and Twitter, Tesla is going to go down to the PEG ratio of 1, so it doesn't look very good for Tesla. Enphase, that's the competitor to, oh, that's interesting. Enphase is down 4%, and its main competitor, which is Generac, is up. So that sector isn't going down together. eBay is down 3%. We'll go over a little news story about eBay. They're making a $600 limit to what you can sell before you get an IRS form. That's really bad for eBay, because then people will try to sell it on Craigslist instead of eBay. I don't see anything in common here. All right, let's go to our talking points. All right, for talking points. We just mentioned Facebook is going up today. They were just upgraded. They said, JP Morgan said, that Meta has the worst behind it. Increases price target to 150 from 115. Big tech has had a tough year. And like I said, the possible catalyst is if TikTok is banned, then they're going to break out of this downtrend. They're in a little uptrend right now, but you can see they're still bounded by this downward trend. That's not so good. All right, so Adobe was up today, and what we're going to do is we're going to look at Adobe's statistics to see if it has any credence, see if we can find any value in that. They posted really good earnings, and they had great earnings forecast. So they maintained its forecast. That is like the most important thing. Doesn't necessarily they met their earnings. That's great, but if they have a forecast that's rosy, it gives people confidence to buy the company. You see, yeah. So they spent money, on a really big purchase of Figma. I think it's a software company, design company. But we're going to go over their statistics to see if it's undervalued. I looked at the annual earnings estimates. You can see it's going up in a straight line. We do like that. But it's only growing at 11%, 14, 13. So I guess the average is 13%. It's growing. Its PE is 22, so that means it's it's trading right now. It's down, but it's still a little bit expensive, like 1.69 times overvalued. The PEG ratio, according to Yahoo Finance, is 1.5. That's close to our calculation. And these numbers are really good that we're following. Return on equity is 33. So basically their business model is they charge for a recurring subscription for their design products. Adobe Cloud, they call it. So every PC user must use their PDF format. So it's monopoly. They give it away, and you can see on our screen here these advertisements. Whenever you use a PDF, there are some people that are suckered into buying a PDF converter or whatever. So you have every PC in the world has this program on it, and they upsell from this. That's like a monopoly. And they have residual income with basically one of the only really good design products, software products. So they have like a monopoly there too. And you have to pay like $25 a month to use that or more based on what you sign up for. But so they have a steady stream of cash flow. That's really good. And they have the best design software. That's great. The bad is, it as the economy goes down, the users cut back, and subscriptions are probably one of the first things they cut out. So you can see, if you're looking at their chart here, they have a lot of support right at this 294 level. It goes back, to the pandemic lows. It went down to 294. So that is, that's where it hit probably in June of this year or July. So we're still close to that long-term support. So so it looks like, if in a bad market, we'll probably go down to 300, and that's probably the lowest it'll go. But we'll watch that one to see if it gets a little less expensive, because right now this PEG ratio of 1.69, if you divide the price by 1.69, you'll get what it's really worth. So we'll wait for it to go down. Get these couple articles that say Verizon is a buy, and then it says AT&T is a buy. And we've been looking at these sectors for a while now, and it's becoming clear that AT&T's growth is slowing. The dividend of AT&T is not as good as it used to be. It's only 5.9%. It used to be higher than Verizon, but now Verizon's 7.7% yield. So their growth, both AT&T and Verizon, their growth is slowing. Verizon's losing customers, and AT&T is growing. They reported, an ad of 700,000. But still, what I did was I looked at their earnings estimates, and let's say AT&T is growing at 4%, and its PE is 7. So it's only growing right now at 4%, so its PEG ratio is 1.75. So even though it's down like a lot from last year, it's still overvalued, and it's losing customers to T-Mobile and Verizon. So you just have a problem where they're going to probably have to cut their dividend. We just see, that's not very good growth. Let's look at Verizon's earnings estimates. That is actually, it's losing customers. It's negative 2% from this year to this year. From this year to this year, it's 2%, and then growing at 4%. So that's not very exciting. They're paying a 7% dividend, so they're 2.33 times overvalued. So it looks like over time, and this is T-Mobile's earnings. Look at this. I haven't looked at this earnings estimate for like a couple of weeks now, but look from this, if this is right, that's pretty amazing. They're expecting T-Mobile to grow their earnings at 300% between this year and next year. That's not doubling their earnings. That's like tripling their earnings. So that's pretty amazing. They're probably taking market share from AT&T and Verizon. So right now their PE is only 19, and they're growing at 33%. So they're like half price, and that's why in a market that's really bad like today, you can see T-Mobile is one of the ones that are going up. Let's see T-Mobile US. Look at that, it's up 1%. So I think for next year, I think this is one of the stocks. If we look at the stochastics for T-Mobile, that's probably the bottom here. Right there, look, we're near the bottom. We're oversold. if we buy it here, it'll probably be a higher highs, higher lows. This is probably the only stock that's worked this year that we're following. And we can see from the numbers that this is doing really good. So in a market sell-off, this will go down with the market in January, let's say, and we can start looking at this and use the 200-day moving average for a time when the stock will go down until as a primary support. Let's look at this. This level right here is held for a long time. See, like that, and then you have this level right here. So if T-Mobile sells off with the market, it'll go down to 130, and then it might be time to start looking at buying some of that because it's a growth stock and it is doing much better than the competitors, and they're probably the biggest in the world, in the country now. They've overtaken the subscribers of Verizon. Okay, so I mentioned this earlier. eBay CEO says, I support the American Rescue Program, but this American Rescue Act included a provision that reduced the threshold of requiring a 1099K transaction. So it used to be if you made 20,000 on eBay, 200 transactions, you would get a 1099K form. But now, if you make 600 a year, you'll get that form. That's going to make people go to Facebook Marketplace and Craigslist, places you can advertise your product and sell it without having it documented. And that's bad for eBay. I don't know how they're going to handle that. But you have to listen to every legislation that's passed. You have to make sure you have the understanding of how it affects your company that you're watching. But it's that could be one more reason that people don't sell on eBay. I don't know. We'll see. They might have to reduce their prices to get people to they might make less per transaction to make it nicer for people to sell online. Okay, let's look at the emotional graph. So for a while now, we were delusional, we were greedy. Just last week, we were greedy, and when we let's look at where we are in the stock market. Okay, so last week we were greedy. People thought we would break out of this, and now we sold off like 5% in the last week. People are becoming missed it. People are becoming more fearful. So they're pretty much in denial. No, it's not going to go down, and it's just when people. Let's look at this. Okay, just when people think that things are getting back to normal, that people get fearful again, and then we haven't had true capitulation yet, but whenever the Fed raises the rates and companies start reporting bad earnings, which probably could happen in January because that's when the next time earnings come up, we'll have a capitulation sometime, and then people are fearful, then the VIX goes up, and then people are despair. That will be the time that you would want to buy. Now when we're at a back to normal, and say if we get back up to here with the Christmas rally, if you're really nervous about being in the stock market, you want to lighten up some of your aggressive positions. When we get up to the top of this trend line. But the worst thing to do is to sell whenever there's capitulation and everyone's selling and there's despair. It's just whenever that happens, if you sell, it's almost guaranteed it'll go up 20% the next day or the next month. So you have to be thinking opposite of everyone else. All right, let's go back to. Okay, we're going in. This is December, traditionally a great month of the year. We just have a problem this year where the raising interest rates meets the end of the year. So there's a 50-50 chance it'll go up for the rest of the year, but we know that we have pretty negative times for the next 3 months, maybe down or sideways until the Fed is done raising the rates. Right, so let's look at okay. Is there anything anyone wanted to go over? No. Okay, what we'll do is we'll go and look at some more market news. Let's look at okay, so then we were just talking about this today. It's very similar to what we were saying. AT&T stock is less attractive as customers. Okay, so we have a problem with AT&T where people aren't paying the bills, number one. Whenever you have a recession, we have customers that are. Can you hear me? Yep. Okay, I got cut off for a second there. Okay. So we have a problem coming up into a recession for these telecom companies where people aren't paying their bills, number one. Number two, they have a very good chance of cutting their dividend. So that'll affect the stock. Some people only own the stock for the dividend. If they start cutting the dividend, the stock price will go down. So we were just saying that kind of confirmed that there. Yeah, we were just talking about Tesla. It seems like Tesla is selling a stock in this Tesla. Elon Musk is selling Tesla. And the more he sells, the more the stock goes down because it makes major price moves. So that doesn't look good until he has two people running two companies, not just one. Let me see. What else can we see here? Okay, how about this? Kathy Woods loses big money on every stock she owns. We've been talking about Kathy Woods in the ARK fund for a while now. She's like the forward-thinking person looking at total addressable market instead of price-to-earnings ratio. And we've been saying that she was either a zero or a hero. And last year at this time, we were saying she's a zero. And what we're going to do is we're going to look at some of her holdings of her ARK portfolio just to see holdings. See if we can see the top holdings. Tesla, Roku, Teladoc, Square, Zoom, Shopify, Spotify, Twilio, Coinbase. So a lot of these are, stocks that have a total addressable market, but right now people are paying for cash flows now, not for the future. So every one of these, almost every one of these is very high PE ratio stock. Let's look at Coinbase. And that's a good coin because we've already looked at Tesla. Coinbase, they're one of the largest exchanges, second largest crypto exchange. And they're talking about crypto contagion, the statistics for this company. The interesting thing about Coinbase, they just IPO'd, and most likely they have a lot of cash. Let's look at their cash. Their cash is $22 per share. So they raised a lot of money during their IPO. They've taken on a lot of debt, $65 billion out of what? Okay, they have a lot of debt. The debt to equity. Where's their debt? $3 billion. Okay, it's only $3 billion total cash. So they have $2 billion in cash. Everything is negative here. We can't even value it now. Everything is negative in our numbers here. Wow, this is like totally opposite of what we've been following in the stocks we're following. Arc Innovation. Let's look at some other stocks. Roku, just for fun to see what. Roku. They're a company that basically it's a channel that people pay money to subscribe to, and then they get certain stations. Another one with all not available, negative for, wow, this doesn't fall within something Warren Buffett would look at. Okay, so she's still investing in companies, and as Tesla goes down in price, she is buying more every day, and she has to sell some of these other lower. As an ETF, you have to buy stocks. Whenever people sell and buy the ARC Innovation Fund, she has to have this. I got to sell a certain amount and then to buy some. And she's buying Tesla as it's going down, and she's selling some of her stocks that have a lower market cap, which really exasperates all of the movement in these companies. It's just spiraling down right now. So let's look at the chart on this ARC Innovation. So just an example of if you hoped that, the future, it won't be until maybe this time next year where people could start buying something like this again and pay for future growth. It's down, wow, it used to be 122, now it's at 33. So that's an example of something to stay away from whenever you have numbers that are missing. It was a good story, but if the numbers aren't there, you have to say, I missed that one, and go on to your next best investment. But let's look at what's happening in the stock market now. Let's look at the indexes. Right. We know on Fridays that traders don't like to hold a lot of inventory, so they don't like to buy. They like to more sell towards the close, usually on Fridays. But don't be surprised if it trades positive at the end of the day. All this triple witching going on. But this Coinbase is just, even though it has cash on hand, just the news from all the crypto exchanges lately will make this very volatile and very risky. I don't know how much some of these the contagion could go on between the companies. I don't know. It's pretty risky. All right, so let's look what else is happening here. Arc Innovation. Look at more news stories, just because we have some extra time. Is there any stocks that anyone wanted to go over? All right, let's look at some more of these news stories. This is interesting. The White House is saying that the oil companies are war profiteering, and they're threatening with new taxes. And the problem is that we need more oil production in America, and if you're threatening companies to tax them for opening up new facilities, then you don't. And Biden's been wanting to lower the price of oil for his re-election bid, and it's like making it so that the oil companies are taxed disincentivizes them from pumping more oil in America and investing in America. So that doesn't make any sense. Let's look at this. Apple is a top pick for 2000. That's opposite what most people are saying. Wonder why this person thinks it's a top pick. So far, Apple has not had a good end of year rally. I guess we have to be a member to see this. Oh, man. Okay, we can't read that article. Get that. Okay, let's look at this article. Can I retire with $2 million? So everyone here probably has a number in their mind what they need for retirement. And let me see. What we're going to do is we're going to do a quick exercise. Okay, why did that open up? Can I retire with there? It's $2 million. Okay. Okay, everyone. There's a lot of people that say, "Oh, if I had $1 million," but $1 million isn't a whole lot to invest for retirement. And the reason is healthcare takes a lot of money to pay for healthcare. So whenever people talk about having $2 million for retirement, they mean they start with $2 million and you take 4% out every year until you run out of money, basically. So what I'm going to do is I'm going to find my spreadsheet for calculating this. Okay, this will be worth it. Okay, whenever you say, do you have enough for retirement? A lot of people start, let's say 2 million. Okay. Okay, so if you start with 2 million investment, this is our calculator that basically starts, let's say it start 2023. What we're going to do is we're going to start with 2 million and we're going to take out 4% every year. Okay, so whenever financial advisors tell you, you gotta save your money until you get to this spot, and after that, what you have to do, your age, let's say 30, what you have to do is figure out how much that you can take out every year and until it runs out. So let's look at so basically the first year, if you have $2 million, you take out 4%, then you're left with this much, and you're earning $80,000 for that year. So you have $80,000 to live off of, and that this 4% is like a standard in the industry. That's assuming that you're not growing your earnings. You're just putting it in something safe and just collecting it. No, you're putting it into a money market, earning almost nothing, and you're going to take out 4% every year. So let's see how many years. Let's say if you retired at 65, 65. Okay, if you retired at 65 with $2 million, let's say you have 100,000 in an IRA. Okay, and let's see how long. That'll last you. You'll get $80,000 a year until you're 100 and that'll last until you're 111 years old. So you'll be able to take out more than that. So you say negative 0.06%. That means you're earning $120,000 a year, and you'll eventually run out of money when you'll still have enough money until 111. So this is how you can calculate, on your own numbers. You got to figure out what your number is of, what you're shooting for, and then say, well, how much do I want to take out? Negative 0.0, let's say 10%. You take 10% out, that's $200,000 a year. Well, you get the idea of what we're doing here. We're basically taking 20% out, which is you don't get 200,000 every year. You get 180 the next year, 160 the next year, and you keep taking that 10% out. You have enough money till you're 110. But that 10% is 10% of what you currently have. But the way I'm kind of planning my retirement is, I'm starting off with a certain amount. I'm planning to, grow maybe. I'll put it in something safe, but I'm growing at 2%. Let's say, once I get my number, let's say my number is 10 million, right? And I want to grow at 2%. Maybe get a bonds, something safe. And if you're growing at 2%, you're not taking money out, then you'll have enough money, and you'll have more money in 20 years than you did when you started. But coming up with this safe growth rate, that's the hard part, because once you reach your 10 million goal, it's not going to be easy. When you start losing money, you have to have something very conservative, like a treasury or something like that. But coming up with this guaranteed amount, that's why, like J.P. Morgan would in this article. Is it J.P. Morgan that said this? And I retired. Let's see what they said. We did our math here. Let's see what they said. The bottom line: retiring with $2 million can increase your financial security market if you're willing to put in the effort to save today. Depends on your details of your financial situation. They didn't answer the question really. So this is, you have to go through this little growth exercise for yourself. Figure out what your total amount was that you need, and then when you get there, you got to say, am I going to grow, or am I going to be very conservative and just take maybe 1% out a year? Negative 0.01%. If you took only 1% out every year, that's when you have $1 million. That's $100,000 a year. And seeing that if you're not growing anything, you just have a money market, that'll pretty much last your whole life. So that's an idea of how to go through this exercise. And it's always important to get to your number. And whenever you get close to there, whatever it's, then you have to say, well, I got to cut back and be more conservative and be less aggressive, I guess. Are there any questions on this exercise?
Hey, Greg, so whatever number you want to assume, like, 2 million and 4% or whatever, I think what you have to do is assume the 4% of the original amount each year. Because if you just assume a 4% of the remainder each year.
Oh, yeah, you're right.
yeah, you're getting down to really low numbers to sustain yourself off of.
Oh yeah, yeah, you're right. Okay, so this calculation is wrong. Then let's say growth rate. Um, so this number actually that sum of C5 times $sign B5. Oh, okay, I didn't get that right. All right, so yeah, I understand. So actually, let's do this. Contributions negative. We know it's 80,000, right? That's good. Let's say 4% is 80,000, right? So this will simulate that. So we're going to take out 80,000, which is 4% every year. And if we use your, fixed sum, then it goes down. You're going to be on minimum wage, but if you use the 4% like I did, you're right. Okay, that was wrong. So now let's go down. It'll expire a lot faster. You're right. See, by the time you're 82, at 4%, you're basically break even right there. So 82. By that time, you'll have both Social Security, if there's Social Security when we retire. You'll have at least Social Security to help you through, until you're 90. Otherwise, you'd have to come up with maybe a smaller number, like 3%, like negative. Negative 60. Rats. I screwed up the formulas. Negative. Oh, it's just a calculation here. Let's say negative 0.0. I can't edit anything anymore. I wonder why. Rats. I'm trying to go to negative 0.03. Okay. So we go to negative 0.03. That's only 38,000. Is that 38,000? Okay. No. You see that count? Yeah, I don't. 2 million. Wait. 2 million.
60,000.
60,000. 1862400. 137,600. Is that right?
Yeah.
No, that's not right. You said 67?
60.
60,000. Okay.
Huh.
Negative 60,000. That's how much we contribute. We basically take it out. So then, with that, that'll last us until we're 90. Okay, that's decent. Okay, so 60,000. The problem with this calculation we're doing here is the value of the dollar goes down over time. So with inflation, so we should have like another, 10%. Right now we're losing 7% of our purchasing power every year in high inflation. But we have to work in the 2% inflation, so that when we're 90 years old, when we're taking out 60,000, that's going to be worth 20,000. That'll buy you $20,000 of stuff today. You know what I mean? So it's not. So we have to keep in mind a 2% per year average inflation rate. So if we were really savvy, we would say, what's your purchasing power at the year end, and that's, whatever the inflation is. So we would say 1,881 times 0.98, and that will give you. Let me see. Let's do that. That'll exercise equals sum B2 B7 times 0.98. That's like an inflation rate of 2%, and that's your purchasing power at that time. Okay, you can only buy that much, instead of that much. So over time, that's why you have to really. That's why inflation is really important, and we didn't really work in what you're going to get after you're age 60. Let's say if you do this, you're age 35, right? When you're aged 65, you're going to be getting some payments from Social Security. So this amount that you get here, you're gonna add like $1,000 a month. for your Social Security, if there is Social Security when you get that old. Any questions about that exercise? I'll send this formula on our chat group so you can mess around with it and do your calculations, get your magic number. Does anyone have a magic number where they're looking to, where they could pretty much stop everything?
Two million sounds pretty good, but I mean, just as you know, I mean, there's just too many variables that you don't know. I mean, you don't know how long you're going to live. You don't know how inflation. You don't know if Social Security is going to be there. You don't know if you're going to have exorbitant health issues. There's so much to take into consideration that you just don't know.
Right, and they did a survey of people across America, Schwab, and they asked them, what do you think is enough for retirement? And the average over all of America is between $2 and $2.5 million. So that's just a good number to, whenever you get around that number, it's probably a good idea to start scaling back a little bit, and you can have some growth, but when we're doing this exercise, it seems like you can basically put it all in cash and just take out a certain amount and have enough. The only problem is that you might have a regret of, wow, I sold my Tesla whatever the market was going down and then it went up, but you got to be willing to scale back whenever you reach that, or when you're closer towards your goals. So it's always good to have that number in mind. I think I've gone over my time limit. Let me see. Let me look at tomorrow. Let me look at the schedule here. Okay, 23rd. No, next week no one's going to be here, but I'll do a talk anyways. But I hope you have a good Christmas vacation and a holiday season, and hope you have good vacation, because I know everyone's going to be on vacation next week and the week after. But you can always watch the video afterwards if you're not here for the actual presentation.
Yeah, thanks a lot, Greg. Happy holidays.
All right. Thanks.
Yeah, thanks, Greg. Happy holidays.
All right, thanks. You too.